right, what is up, and welcome back, everyone, to another episode of the Long Game Podcast. Here I am with my co-host Ben Lake, which basically we are now. But I'm Thomas Kopelman. If you guys didn't know, a little different intro than normal. Ben, I'm excited to have you on today because I feel like most times when we have you come on, we do like very specific topics, like how to plan for an IPO or long short direct indexing, things that I think you're perfect for. But today we're going to switch gears, and it's almost going to be like rapid fire, financial topics that are really debatable, whether people feel strongly about, rent versus buy, or lease versus own a car, or, get a car loan versus always pay in cash. So I'm basically going to pull up some topic. You're going to go on it. I'm going to go on it. And then we're going to go to the next one. And we'll probably do like 10 or so. The first one that I want to start with is rent versus buy your home. Your thoughts?
Cool. Well, I'm excited for this. We've never done this before, but I kind of love it. Rent versus buy. I mean, for most of these, my responses are going to be, it depends on something. But in this case, I feel like rent versus buy really comes down to like the point in life where you're making this decision in the first place. Like obviously when you're moving around a lot and maybe you need some flexibility of where you're going to be located, renting makes sense. Does that mean renting forever is the best for every person? No, probably not. But owning, you obviously have roots in the ground. You probably have in general speaking, you probably have a much lower overall cost to own if you're going to stay in that place for a long period of time, right? 10 plus years in the same place, almost always going to make sense to own it. Almost always. That's not always true, of course, but by and large, that's what the math that we've looked at has generally said. So
especially when the costs are similar, right? When the yearly costs are similar, I think that's true. I think the issue is that a lot of times people were renting and they're like, well, if I'm going to buy, it's got to be like my forever home. And so then they go from hey, we rent a pretty nice home to we buy something that's twice the square footage, twice as nice, or you're even just in a place like, New York City or California, certain areas, LA, et cetera, where the cost to buy is so much more than the cost to rent. And that always amazes people. They're just not true. They're like, if the mortgage would be 10K, that means they're charging me 10K. And it's that's just not true, because these people have potentially owned the home for 20, 30, 40 years. They refinanced in 2020. Their mortgage on this might be 4 or 5K and your new mortgage would be 10. People think well, that automatically assumes that they'd raise it to 10K because that's market rate. And that's just not the nature of how things work. But I totally agree with you on what you're saying. I think the issue is that if you're going to buy in the short term, transactional costs are too much, right? Upfront, you have all your closing costs, blah, blah, blah. You're basically only paying interest. Really, the first 5 years, it's basically 95% interest. And then you sell and you have 5 to 6% transactional costs. It's really hard to make money in the short term. And yes, there's the examples of people from 2018 to 2024 or 2020 to 2023. They made so much money, but you're also looking at a time where houses appreciate more than they ever have. And so we already know that houses relative to income are more unaffordable than ever. But then people all of a sudden assume you're going to have this crazy growth rate of homes over the next 3, 4, 5 years. And things have definitely slowed down.
Totally agree. I think the other thing that we track is that ratio of what is the average monthly cost to buy versus the monthly cost of rent? And that changes over time, right? It depends a lot on the overall health of the real estate market. It also depends a lot on where interest rates are, right? So back in 2018, 19, 2020, when interest rates were super low and home prices hadn't skyrocketed yet, it definitely was cheaper to own than rent at that point in time. But that has completely reversed, right? 2026 right now, it is dramatically more expensive to own on a month-to-month basis than it is to rent the exact same place.
Yep.
And that's because of where home prices are and because of where interest rates are. So there's probably going to be times in the future where if we answer the same exact question in 5 years or even 10 years or longer, we might have a completely different thought process about hey, actually right now it is generally so much cheaper to own because of XYZ, whereas right now it's the opposite.
In 2020, 2021, 2022, it was so obvious to buy if you were in the market, right? It was this is a great time. Prices have not gone too much up. Rates are as low as they've ever been. You can afford a really nice house for a really low cost. Mm-hmm. Today, We don't know. Rates might stay this way for a really long time. Like historically, 7% is kind of average, and we're right around 6. So all the people are like, well, prices are going to go down or interest rates are going to go down isn't necessarily true. So the thing really is like, can you afford this? What's the right timeline? Are you going to live there long enough? And just making sure it fits that yearly budget. And if so, and you're going to own for at least 7 years, I would say like buying is going to be better. If not, renting is going to be better. That doesn't mean you have to rent, right? Like part of, we work with very successful people. Part of their financial life is that they're not always making the best financial decisions. And I think that's weird hearing this from a financial advisor. But a lot of what I help my clients understand is that you went from, maybe you grew up in a way that you didn't have a lot of money. Today you have a lot of money. Those general rules of thumb maybe don't exist anymore, but in some ways they do, right? You can spend 28% of your gross income on a house, right? Like, all these different things, they end up doing less. We have a client who's making $2 million a year, so over 150K a month. They're probably not spending $40,000 to $45,000 on a mortgage, but it sounds crazy to them to buy, a house that might be $3-4 million because they don't know anybody who would ever do that. But it is affordable. Would it be better to rent a $4,000 a month place than buy a place with a $30,000 mortgage? Yes. Best financial advice would be spend as little as possible, go on the cheapest vacations, drive the oldest cars. But like, that's just not the reality for people with a lot of money. It's just really learning to spend in line with what you make.
Yeah, totally agree.
Okay, let's go to the next one. The next one, I'm going to stay kind of on the house side of things of paying off mortgage early or invest.
Ooh, okay, tricky one. In my opinion, it's all dependent on the interest rate of that mortgage that you've got to a large degree. I, generally speaking, in the last like 15 years, where interest rates on mortgages have just not been crazy high, I've generally suggested paying off your mortgage more slowly and prioritizing investments for the most part, right? Because when you look at a mortgage interest rate and you're paying it off early, the reason you're paying it off is to basically say like, okay, I want to have this like known interest rate at which I am saving money, right? Let's just say it's 6%. When you pay it off, you're going to save that 6%. However, there's also the tax benefits, if they're already in your situation for paying off the mortgage, every month. That interest cost might be deductible on your, Schedule A. So you're really paying off the net of tax interest rate, which for some people is 6%, for some people is significantly lower. And so if you can reliably and like you're comfortable with the volatility, invest in a way that earns more than 6%, you're better off in the long run doing that. Right. And that depends on a lot of factors, on what your investments are like, where your focus is, how comfortable you are with risk. If you're a retiree and you're not interested in risk and your portfolio is, maybe fixed income focused and you're only earning 4 or 5% a year, then you're absolutely not going to plan to pay off to prioritize your investments because they're not out earning your cost of the mortgage. So I think it depends a lot on the interest rate, but generally speaking, for the clients that I'm working with, most people are probably just paying it steadily. I probably am biased in a way that I would rather see people's net worth, grow in the maximum way possible. But there's also the fact that some people have a personal feeling where like the value of being debt free as soon as possible is very high, maybe above just having more money in the bank. And that's fine. It's very personal at that point. That's totally okay. That's where I think I fall on the spectrum. What about you?
I think it's an interesting one because I think there's a bunch of points in here that need to be talked about. And you talked about a good amount of them. I think, of course, the interest rate matters. If you have a 12%, mortgage, paying that down, it's a known rate of return versus the stock market is obviously kind of a question mark of where it goes. Mm-hmm. There's also this side of like, okay, well, if you put money into your house, it's pretty illiquid. Sure, you can borrow via, HELOCs, et cetera, but that's going to be above mortgage rates. It's also going to be variable. So there's a bunch of risk there. You still have to pay it down. And so generally, like I think through the lens of liquidity, and I think liquidity matters a lot. I'd rather know I have the liquidity to pay off my mortgage if I really wanted to than actually have my mortgage paid off. I think another part of it is, your mortgage does get cheaper every year due to inflation, right? So 15 years from now, my $5,000 a month mortgage payment is drastically cheaper than it is today. So I think like, debt that gets cheaper on an asset that grows over time is something that I am extremely comfortable with. I think the other part about it too, when you think about paying off a mortgage versus investing is, what would be the net cash change? So I had a client, he's like 30 million net worth. He has about $3 million left on his mortgage. His mortgage is $30,000 a month. So $450,000 a year is principal and interest. And bonds would get him $120,000 a year. And he has bonds. Why would we hold bonds? It's not just interest rate of bonds versus interest rate of the mortgage, because it's also what would that cash do for you? Because somebody who might have $1 million left in the mortgage, but it's only, $2,000 a month. Well, bonds would actually yield you more and give the liquidity. In the example I'm giving, it is significantly better. So instead of bonds creating income, we pay off the mortgage and reduce the income that's needed from his investment account. So I think that variable also matters. But I think if we just kind of core belief, I don't pay a single dollar extra into my mortgage. I invest every excess dollar. I think it does become specific to people, right? If the rate's high and you're going to have a lot of bonds at a lower rate, well, maybe paying off the mortgage makes sense. For me personally, I'm a 100% equity investor. So I'd much rather invest it, build liquidity, know I could borrow from my taxable account and pay down my mortgage in a lower rate if I really wanted to.
No, totally. And the other thing that you give yourself the option to do by paying it slowly, like you're saying, is if rates do go down, you can refinance that mortgage. You've kept your liquidity, but you can refinance that mortgage at a lower rate at the the level the mortgage is supposed to be at.
And sure, you could take out a mortgage too if that really did happen. Yeah. But I think it is a variable worth considering. If you think rates will go down over the next 20 to 30 years, you will have that ability to lower the effective, interest you're going to pay on that loan.
Totally. And usually if you've already paid down that mortgage a lot and you're going to refinance, but you want cash out, usually you actually get a higher interest rate because you're taking cash out.
Yeah.
Right? So I just need a little more flexibility. And the liquidity point is a really excellent one. By maintaining the initial mortgage plan, pay it off slowly, and prioritize liquidity elsewhere. Yeah. Like that a lot.
The last part I want to hit on there too is just you have to be investing a good amount of your income to even think about paying more. So I think, general rule of thumb, I think, is you should be investing 20% of your gross income. If you have surplus above that and you do want to pay down your mortgage, I think that's where you consider it. But if you're like, I'm only investing 10, 15%, should I go pay down my mortgage? Even with interest rate variability here, you probably still need to go build net worth and build liquidity for the future.
Yeah.
Perfect. So next one, let's go to lease versus buy car versus finance a car.
Mm-hmm. Okay. So for leasing versus buying, if we're just focusing on that for a second, I think, the simple math that I've seen is basically that when you buy cars, if you own them for the long period of time, let's say 7 to 10 years, over the course of your life, you will have spent quite a lot less on cars than if you leased for your entire life, right? Sort of simple as that. So I'm generally biased towards buying a car and then holding it for as long as its useful life will let you hold it, basically. Leasing, however, in certain circumstances can make a ton of sense. Right. Some people just want to have a newer car more often. And if you were to buy a car and sell it within 3 years, you're actually better off leasing, right? Because the depreciation is so much more dramatic in those first couple of years of a car's life that you're better off leasing at that point in time. However, there have also been some cases recently where, because of, either new technology advances in the car world or just tax incentives, it has actually made more sense to lease than to buy, no matter what. Right.
It's the electric vehicles, if you lease, you might get that tax credit that you wouldn't get if you buy. And also just the depreciation of batteries over time that, selling an electric car is just not worth very much. But also leasing is pretty cheap. Like a Tesla, you can lease for a net like $350 or $400 a month. Like when I did mine, I sold my car for like 12 grand, leased a Tesla for 3 years, and I spent like $3 grand.
Yeah, it's awesome. That was great. And I think that's the kind of thing I'm always on the lookout for, because you can have these rules of thumb, but when stuff like that comes up unexpectedly, it just totally makes sense. Plus, I think the EV world also continues to develop pretty rapidly, right? Battery technology has a lot of room for improvement. So if you had your Tesla when the range was, let's just say 300 miles, and now in a couple of years, it's going to be 600 miles, you're going to wish you leased so you could have that 600 mile range on that car 3 years from now. I think that speaks volumes for why we don't want to be so overly focused on these giant rules of thumb for too long for everybody.
Yep. Yeah. I don't think I have too much to add there. I think I agree. I mean, again, if you just want a new car every few years and you're going to get it, like at least it's fine. Just make sure again that this is something that fits within your budget. I think the next one that I'm going to, I'll lead on is buy versus finance. And I think there's like everybody's parents tell you to never finance a car. And I think the good idea, the reason why I think that's good advice is so you don't buy more car than you can afford, right? So the thought would be like, well, if you can't afford a $50,000 car, well, then I'll just finance it over 7 years. And, of course, then you're going to pay 70 grand, for example. Like that's not really the best move for you. But if we take that away, because we know the clients that we work with can afford these, like we have clients who have $200,000 cars, $300,000 cars, whatever, like they can absolutely afford this. It fits their budget. It doesn't even make a dent on what they get to retirement wise. I actually think it's an interest rate thing. I financed both my cars. I could have paid cash for both of them, but I got like a 3.9 and like a 4.4, right? Like to me, I'm going to take that. And I know in the last few years since there, my portfolio is up like 20% a year, right? Just 1 year of growth on that covered more than the interest on the entire life of the loan will be. And the monthly payment doesn't affect my budget in any way. I'm still spending like, my total monthly spending is maybe 25% of gross income, so like I think that really changes the variable. As long as you start with you can afford it, if you get a good rate, do it. If you're going to get a 9% car loan or you have a used car loan, I just looked at a new client of mine, it's like 12% used car loan. That's a terrible decision. That just becomes super expensive. It's not deductible. Nobody that's a high income earner has deductible car interest.
Yeah, I totally agree. It's hard to generalize too because the car loan market is weird. It's a weird market, right? If you look at if you go to the banks, they're the ones who are usually the ones in that kind of like 7 to 12% range for interest rates because they're giving you a standard loan. But sometimes if you go to a dealership and you're using that company's financing division, every once in a while they'll be like, you know what? This quarter we're having a promotion and the interest rate for all auto loans is 0.0%. Great. That sounds awesome. Why would I not take that kind of situation? That can make sense to me. 2 to 5%, generally extremely attractive, like you're saying. Because you can even outperform that with like a basic, high yield savings account in some cases or bonds. But I think if you're looking at a finance versus buy question and that interest rate is super high, avoid it if you possibly can.
Switching gears a little bit, Roth versus traditional.
Yes. Again, much depends here. This is one where I would never tell any client I have the exact answer for you and you're going to do this forever. Because I've had most clients where we start with one and move to the other and maybe go back and forth over time. With Roth versus traditional, I think you're really playing a tax bracket, game to some degree over the course of your life, right? Not everybody knows, obviously what tax rate they're going to be in, at age 20 versus 30 versus 40 versus 50 versus 70 versus 80 versus 90. So to some degree, there's also something to be said for just tax diversification, having a little bit of both. But I think it's super dependent on the tax bracket you're in when you're making this decision, and it depends on where you think you'll have the opportunity to be in the future. Because even if you're somebody right now who's in a very high tax bracket, and you're going to work in that high tax bracket for the rest of your entire life, it might make sense to be pre-tax for a very long period of time. But if you're going to be in that high tax bracket forever, and you have the income to just pay the taxes, it could make sense to be Roth. But if you're in that high tax bracket and you're probably going to retire early or you're going to take a break at some point, if you go pre-tax, you give yourself the ability to do Roth conversions and really save yourself taxes over your lifetime. So it's really worth being strategic with that particular question, in my opinion.
Yeah, I think if we're thinking IRAs, it's basically Roth or backdoor Roth almost all the time. Like generally, like if you can contribute to a pre-tax IRA because your income's low enough, hard to imagine that you should not be contributing to a Roth and locking in this 12% tax rate. 401ks, I think you're right. Like I think generally, if we're going to rule of thumb this, it's like 32 plus, generally pre-tax, 10 and 12, generally Roth, 22 and 24, generally Roth, but it depends, right? If you're like just touching 22 and 24 and you're in your late 50s or 60s, like pre-tax might make sense because you probably are going to have, lower brackets in retirement. If you're touching 24 and you're in your 20s or 30s and you're steadily growing your income, Roth probably makes sense. Like I personally do Roth in 37 today. Why I'm, 30 years old. I did not want to do pre-tax. I've been in 32 plus for at least a couple years. I don't really want to do pre-tax for 40 years because I don't think I'll have enough room for Roth conversion. So I plan to do pre-tax really until probably mid to late 30s and then do pre-tax the whole rest of the time. I'll do profit shares into 401ks, et cetera. So I think that time frame does matter a little bit. And then again, you're totally right. If you're going to have times like post a business sale, starting a new business, early retirement before Social Security and RMDs, and you have room for Roth conversions, I mean, in general, you're not going to have a lot of income at that period of time at all, right? You might have a little bit of interest, but again, you could game it. You could move, what you're holding to try to get as little out there. You can do donor advised fund contributions to help offset it and really then lower that effective tax rate. But comes down to you. It's not bad to do Roth, right? Like I think if you really want to, you can absolutely do it, but I think that you have a little bit more control. And in general, Social Security and RMDs most likely are not going to push you into 37. Like they might push you all the way into 24. And even if you have a bunch of room in 24 and 32 and 35 with effective rate of 29 versus deferring or paying at 37, still good tax planning. Plus, if you plan to, hey, I live in California, New York, but I'm going to retire in Florida, just white that whole state side of it not existing is also another important variable to consider.
Yeah, totally. And I think that it brings up a really good point. Like some of these, analyses when we answer this question can be pretty intricate, right? It depends on how much you're making, depends on where you live. It can depend on how much you already have in pre-tax versus Roth accounts, right?
Maybe
like,
with cash balance plans and other things, and it's huge.
Yeah. Yeah. If you've been pre-tax forever and you've amassed like a huge amount of like, maybe it wasn't just you contributing, maybe it was your business contributing for you. If you've got a big pre-tax pool, even if you're in a high tax bracket, it might make complete sense to contribute to Roth, kind of somewhat counterintuitively, but that's just how the math works out in some of these cases. It totally depends on a lot of very personal factors. I think that one's really hard to overgeneralize about.
Yeah. Yep. Let's stay on the investment side of things. I got a few other ones that I want to do. Okay. Lump sum versus dollar cost average. So let's say post business sale, selling concentrated position, massive bonus or carry hits, inheritance hits, big amount of money in cash now. Do dollar cost average it or lump sum?
Man, this can be a tough one because academically, and tell me if you agree, academically, I think the answer is just historically lump sum is the way, right?
Yeah, the statistic is somewhere, everywhere is a little different. It's somewhere between 68 and 75% of the time lump sum outperforms. And that's just because generally, 75% of years the stock market is up. So if we know your odds of 1 year stock market returns are positive 75% of the time, 75% of the time, it's going to basically make sense to do lump sum. When we're just looking at numbers, the result is I think over 30 years, it's I don't know, 1 or 2% higher annualized return, which can be meaningful, obviously.
Yeah.
Doesn't mean it's the right decision though.
Yeah. I think that's where my bias generally is listen, that's the numbers, right? It's right there. It's right in black and white. The answer is lump sum. Of course, there's plenty of times where we will be a little bit more tactical than that, either because of what we're looking at in terms of the markets, right? If the market is telling us, hey, everything is very highly valued, there's a lot of unappreciated risks out there, then we probably would say, you know what, this is the time to dollar cost average. We don't want to be too slow with it. We don't want to. Is that
what you'd say today?
And today actually is probably one of those days where I'm kind of all right, if you're having a big cash infusion and it's just cash, it wasn't already invested in something, I would probably say, let's at least spread it out over a few weeks or a few months, not years, but let's at least spread it out a little bit. However, I would say in general, if something is, if this windfall is something that was already invested, right? Let's say you left one company and you're just rolling over a 401k. History shows that if it's already invested capital, it's actually not good to take it out of the markets, right? You do want to keep that invested.
Yeah.
If it's a pure cash infusion, right? A bonus, an inheritance, a business sale, that's what we're talking about is that's why you would even ask this question, I think.
Yeah.
But yeah, now is one of those times where, when we're looking at the whole global stock market, I think there are a decent amount of parts that look pretty highly priced, hard to see a lot of other future, immediate gains there. There are some things that are more attractive, right? We don't just look at the US, for example. There's plenty of things outside the US that are a bit more interesting valuation wise. But at the same time, it's sort of that's just one angle of it, is looking at where the markets are. The other angle, I think, for some people is where are you at in life, right? Are you comfortable taking risk with this big amount of money? Or like, for example, do you need to have some liquidity? Because if you sold a business and your plan is to kind of like fully retire and sail off into the sunset, you might want liquidity for the next 2, 3 years or 4 years in like a bond ladder that defines your withdrawal strategy, your liquidation strategy, so that you don't have to deal with the risk that markets go down as soon as you
Yep.
retire.
Yeah, it definitely all starts with goals, right? Like, do we have house purchases or paying down debt or funding, emergency fund their kids' college? Of course, there. Now we have the leftover amount, and I think like really the way that I approach this is here's the data. The data says do it, but that might not mean you do it. Would I do it? I probably would, to be honest. Like I'm very comfortable with the market. I know if I don't have to use this money in the short term, I can wait for it to bounce back. But what we do know is that, the market might average 10% a year. It's never really around 10% a year. We have a bear market on average, like, every 6-ish years, and that decline is going to be about 30% over 10 months. So what we can tell somebody is, okay, what if you put this in and it is the top and we have a 30% decline? So your 10 million becomes 7. Or, what if you put it in and it grows by, 14% a year and you're at 1, you're, basically 11, 4, whatever. Would it feel really bad to go to 7, or would it feel really bad if you don't invest all of it in and you miss out on the 1.14? For most people, that down feeling is way stronger. And so when that's going to be the case and they're going to then panic, sell out of the market, right? The ultimate goal is how do we get your money invested for the longest period of time possible? We're not worried about short-term returns. Yes, we care about them, but like long-term returns is really where you make your money. So most people I found picked a dollar cost average. And what I generally say is, okay, let's either do, 1 year monthly. Let's do like a quarter up front, the rest over 6 to 12 months, half up front, the rest over 6 to 12 months, 75% now, the rest over 6 to 12 months, just quarters over 4 months, something like that. Let's pick a strategy. We're going to absolutely stick with it. It's going to be the same day of every single month. And if the market drops a ton, I'm going to reach out to you and ask you if you want to accelerate that. Right. And so now we have an agreed upon plan. The average person who does this themselves, they don't follow the plan, right? The market's up and now they feel scared to put it in. The market's down, they feel scared to put it in. And then they just wait. And all of a sudden it's people from, earlier this year, April of last year, end of 2022, 2020, and they just sit out of the market. And now you've missed basically a doubling of your money over 6 years. Like you've got to take the emotion out of the decision, look at the data, pick the strategy you want, stick with the strategy, take your emotions away.
Yeah, totally. And that's a lot easier said than done, but I think just having that plan in place, right? Here's the schedule. And if you can automate it even better, that you don't have to actually hit that button every month. I think that's such a good idea to actually enforce the ability to, get the funds invested, because it can be so inefficient to see that, cash just sit there for years at a time in some case, right? Like if, for example, I would talk to a client recently where they had that exact paralysis in 2020, right? Like obviously it was a scary year. There's a lot of stuff going on with COVID. Markets were down a lot. Markets were up a lot. They kept that cash for not a few months, for a few years, and missed out on like literally tripling their original investment amount because they just didn't have that plan already in place. Like, yep, we're going to get it automated once a month. We're just going to do it like clockwork. If they had done that, their net worth would be a multiple of what it is today.
Yeah. Yep. Completely agree. Okay, I think that's that on that one. Next one I want to talk about quickly is index funds versus direct indexing.
Oh yeah, interesting one. Index funds versus direct indexing, I think, is a newer question, right? Because direct indexing has sort of risen in popularity a lot over the last call it couple of years. To me, I feel like direct indexing is sort of like a good, healthy evolution of low-cost, diversified indexing as a general investment philosophy. Yep. So I am certainly generally pro on direct indexing. Is it for everyone? No, doesn't have to be. And that's totally fine. Like the point of direct indexing is to be able to give yourself the ability to harvest losses, tax losses, while keeping your performance almost exactly the same as the overall index. To basically just increase your tax efficiency over time. There is usually a small fee difference between the two, right? An index fund might be like 2 or 3 basis points versus 10 basis points, 12 basis points for a direct index. So the value of that, tax efficiency has to make up for that fee difference for it to be worth it for each individual person. But for most people that we work with, The value is going to be there. The value is going to be there, especially if you're like a business owner with a transaction, or if you're, an employee with equity comp, and that equity is going to have a growth in value over time. There's a lot of different ways that those could rack up. If you're somebody with short-term, capital gains, right? Like we have traders who have a lot of short-term capital gains, it's almost a no-brainer to focus on direct indexing and even go long short with it, to be more aggressive about it. But I think index funds are still going to be a great first building block for the vast majority of people. Like it's one button to click in your brokerage account. It's instant diversification. Either it's, the whole US stock market, the whole global stock market. It's such a good first step to take that I don't see direct indexing as a full replacement, as it's just more of a natural extension. So it's not one or the other for me. It's sort of like, when does each make sense?
Yeah, I agree. I think for me, it's really like obviously ETFs and all tax advantaged accounts, direct indexing and taxable for people who are in a high income bracket, who have, capital gains all the way up to 37% in California, pretty close to that in New York. People have concentrated positions, large taxable accounts, business sales coming. If you're somebody that almost everything's in tax advantage accounts, you're really not going to have capital gains, you have a small taxable account, probably not really worth it. It doesn't hurt because the costs are actually pretty low today, but I do it for myself. Most of my high income earning clients do. Anybody in those situations we talked about generally do it. I think when we don't really have to go down the long short route. I think long short is not obvious. I think long short is really only obvious if you have very, very large concentrated positions we're trying to get out quickly while in a high bracket, or we have a huge business sale that we're planning and prepping for, and we have a good amount of taxable accounts. But the general person who's like, has some equity comp, has a smaller business sale, something that isn't huge in capital gains, I don't think post the cost, it might end up being significantly worthwhile compared to long only. But I do think long only would still fit in that situation.
Mm-hmm. Yeah.
Okay.
Agreed.
What about term versus permanent insurance?
Oh, man. So, I mean, both solve, in my opinion, very different problems, right? They're both tools to be looked at. And I think you've actually posted this, Thomas, but like, term is not always the best for everyone. Permanent is not always best for everyone, but it doesn't mean you should never use either one, right? Like, I think there's a lot more scenarios where term life insurance is appropriate versus permanent, because in my mind, permanent life insurance, is a bit more, it's a much higher cost vehicle. But it has a lot more potential, like ways to customize it or ways to make it applicable. So I'll mention a couple, but like in general, I'm very much of the mindset where like, if you need life insurance, which is an if, not a guarantee, the first thing to look at is if you need it, covering it with term is probably the first step, in terms of solving that problem. If you need permanent, it's usually either as part of your estate plan, right? A strategy where you're trying to use life insurance to either simplify or help pay down estate taxes because you're above the estate tax threshold, maybe have a more illiquid overall net worth structure, right? With a lot of real estate or businesses. And if something happened to you, putting those things up for sale quickly would have a big impairment on the value of those things. Great. Permanent life insurance can be fantastic, right? Same thing if you're using it within a business ownership perspective, right? Like succession planning. Permanent life insurance is a great tool for succession planning for a variety of reasons, but I won't go into right this second. But the other one that I've seen a lot actually more recently is, excuse me, is using different kinds of permanent life insurance that also have a long-term care benefit to them, right? If long-term care is going to be an affordability issue, permanent insurance actually has a really solid place in making it more affordable than just pure outright long-term care insurance. So those are the things that come to mind. But I'm curious, like, do you have a similar set of reasons you look at permanent versus term for?
Yeah, I think like when you say like permanent isn't right for everybody, term isn't right for everybody, term is more right for everybody than permanent is more right for everybody by a mile, right? Like if you are in your 20s, 30s, 40s, you have kids, like it is so expensive to cover the life insurance need through permanent. Almost never do I see somebody having their life insurance need covered from permanent. It's normally you have term to do that and then you have permanent for a different goal. I think, I think estate tax planning, I think potentially hybrid long-term care, yes. But the other one that I think about for people is maybe you have a large liquidity event, maybe we had a business sale, and we can max fund a permanent life insurance policy over 1, 3, 5, 7-ish years. And instead of putting money into bonds, we're going to do that, right? Like I just looked at one for a client where it was Northwest Mutual, which I'm not a fan, but their insurance policies are fine. And it was basically like if he just funded this yearly over the next, 30 years, he'd have like a 2.2% IRR. If he max funds this over 7 years, he'll have like a 6.2% IRR. That's a pretty good rate of return for something that is going to basically make him say, like, right now he has a bunch of bonds and, basically like high, low growth, high dividend type funds. It's like, we're going to scrap that. We're going to go really high growth in your equity portfolio. And because of this, that's going to give you that ability. Plus the break even period is way earlier. I think a lot of people get sold on permanent life insurance as this like tax-free vehicle, when in reality, like you're just borrowing your basis. Like if you were to cash it out and it was above your basis, you pay income tax on that growth. It's not actually this tax-free vehicle, just like how I can borrow from my taxable account. When I borrow from my taxable account, I don't pay tax because I'm borrowing from the value that's there. So I think there's like a few misconceptions inside of the permanent life insurance side, but also like you can't borrow early. If you borrow in the first 3, 5, 7, maybe even 10 to 20 years, you will kill this policy, right? Because that part is not going to be growing in the same way. And people just think it's like, put my money in, I'm going to borrow now to buy a house. And it's like, you don't realize that like that policy is going to be terrible over time. So to me, I'm like 98% of the time term, 2% of the time permanent, very high net worth, maybe permanent, but it's still not even like hey, I have 70 million, get permanent to cover estate taxes, because the 70 million might be all in equities. And it actually might be better to just pay that from, selling some investments or doing something along those lines.
Yeah. And you're super right. There's so many misconceptions out there about permanent insurance in general that I think it's always worth, like if someone's considering it, like it's always worth at least reviewing it with a fully independent RIA who's a fiduciary, like get a fully objective opinion on it, because the tricky thing is that the insurance world is just kind of rife with conflict of interest, right? There's so many conflicts out there that it has become very difficult to trust, just anything at face value from someone who works, on a commission-based structure because they get paid more to sell more insurance. So, a lot of them are good, of course, but some of them are not. I would always want to get that second opinion on permanent insurance, because there's so many things that get like, put out there either as, misconceptions or as sales tactics, or as just sometimes it's just pure misinformation. But like realistically, I think there are plenty of good uses of permanent insurance. Some of them are totally valid. Some of them are way overhyped. But like you said, term is very, very frequently the right answer, and usually the only answer if you even need life insurance in the first place. But permanent can be used to solve like much more specific problems.
I agree. Any other ones that you can think of for today? I'm trying to think if there's any other interesting ones that could be worth talking about.
Yeah, we've hit a ton. I think one that I've been getting recently is also like, it's sort of an extension of the, passive investment versus active investment concept, where, in some asset classes, of course, the answer is already well known, like passive is a very good way to do it. But the question comes up for me where we're starting to look at, what about private investments, right? Like how do they add value? Like when do they make sense? And I think that can be very personal as well. Plus the private investment world has a very wide range of definitions of what that even means, right? Like private equity is completely different than private credit, for example, and solves totally different portfolio problems. But I don't know if there's as many misconceptions out there, but I've heard recently that like, our team, which is generally pro private investments in this environment, not always, but in this environment, will happily recommend some of the ones that we vetted and like a lot. But there's other advisors out there who are basically just like permanently anti private investments because they're high fee, they're active, why bother, that kind of stuff. I'm curious if you have any experience with that question, or if you have a specific take on it.
Yeah, I think with a lot of the clients we share, privates do become an option, and I like letting your guys' team vet them. I think For me, things that get to my size firm are kind of like, well, they got passed down from a lot of people to get here. Is that the right move? But I also think for the average client I'm working with, like I think about, 75% of my clients probably are business owners. Their private investments are their business. Like I don't want them in something that's illiquid, not always going to be available to be pulled upon. So I think like when you own a business, everything should be liquid, accessible, super easy and low time commitment. And then when I think about my other clients, they're typically people with concentrated stock positions. And so like they're holding a very large part of their net worth in some individual company, a lot of times private. Like that to me is that same exposure. I think post those events is where it can start to make sense, or they've built up a lot of liquidity and, or they're selling all their RSUs quarterly and now they have times to start to think about it. But I think you have to reach that level for it to start to make sense. If you're not very liquid, if you're already like, I'm 40 million net worth, but 39 million is my business, I don't think we need another illiquid asset.
Yeah, I think it's a great point. The liquidity lens is huge. And you're right, like it makes a lot of sense for some people and can absolutely like enhance returns and create more diversification, but it's not for everybody, right? We don't need to, like proselytize it for every single person out there, right? Especially the ones like we said earlier. If a couple ETFs are a great start to your portfolio, you don't need to go crazy and start adding privates to that kind of thing.
Yep. Okay, perfect. Well, I feel like that was a lot of really good topics. I mean, I love doing this type of episode. So Ben, appreciate the time. Everybody, thank you for listening. Please don't forget to rate this podcast, share with another advisor, and we'll see you back next week.